Hello, welcome to Any Answers Answered for May 2022. We are, of course, getting closer and closer to April 2023 and the new rules, the old rules on corporation tax, 3 different bands of corporation tax and the problems that come with that, association, close investment holding companies, all that sort of thing. And our first question, in fact, is to do with exactly that topic. The question comes from Floggle, who asked a question relating to unpaid interest receivable. The question is, I have a client who is a close investment holding company. They have lent money to a company associated by common control. They've charged interest on the loan, but the loan interest has not been repaid. Neither have some of the repayments. And the question is, the unpaid accrued loan interest, is that chargeable to corporation tax or can it be added back in the tax computation? Tim, what do you think?
Well, there's a very simple answer to this question, but it does open up a discussion about the changes to corporation tax that are coming in just under a year from now. But the simple answer to the question is that interest for corporation tax is dealt with on an accruals basis. When I first studied accountancy, that wasn't the case. When you first studied it, I think it was the case. But for many years now, interest is taxed on the basis of accruals rather than actual receipt. So this company is owed interest by the borrower. The loan interest has not been paid, but should be accrued in the accounts. So debit debtor, credit the profit and loss account, and that will be subject to corporation tax. Unless you can show that it's a bad debt, you wouldn't be able to avoid paying corporation tax on that interest. There is some discussion in the answers on AccountingWEB to this question, but one point worth making is that if this is a close investment holding company, then next year it's going to be subject to tax at 25%. The corporation tax rate of 19% goes up to 25% from the 1st of April 23, and that will apply to close investment holding companies irrespective of the level of profit. So the small profit rate, which will be 19% next year on profits up to 50,000, won't be available to a close investment holding company. Despite that, if that company has an associated company that is not a CIHC, a close investment holding company, and that's the case here. The client company here has lent money to a company that is associated by common control, and let's assume that's a trading company. Well, the associated company can benefit from the small profit rate next year of 19%, but the profit limits will have to be divided equally between the two companies. And even though the CIHC will pay 25% on all of its profit, the associated trading company will only get the 19% rate on the first 25,000. So it seems a bit unfair, but life is unfair. And then a final point around this particular scenario is that if the money had been lent not to an associated company, but to an individual, then the interest paid by the individual, if it is tax deductible, and that's quite a big if, but it may be that the individual has used the loan for a qualifying purpose, not that there are that many of those these days, the individual will get tax relief on a paid basis, but the company would be taxed on an accruals basis. It's normally of interest the other way around, where I lend money to my company. If I lend money to my company, then we can exploit this by delaying the payment of interest to me into a later tax year without delaying the corporation tax deduction, because that's on an accruals basis. But simple answer, interest for a company is taxed or allowed on an accruals basis, not on a paid or received basis.
It's an area of tax that seems incredibly straightforward until you really start to think about all of the implications, all of the different bits and pieces. As is our second point, actually, which is to do with the 60-day CGT returns. Our question comes from Jigs, who asked the question relating to exactly that. Jigs says they sold a residential property in March 22. this has been included on the 22 tax return, which has already been submitted within 60 days. Does the 60-day return still, is that still required, as the actual information has already been included in the self-assessment return, and therefore jigs suggest this would be overkill. But actually, I can answer this one. It's not overkill because you don't have to do both.
You were talking about close investment holding companies this morning. At 5 to 9 this morning, before the start of my lecture, one of the delegates, first one to arrive, said, "Oh, can I just ask you something? His client sold a residential property last month, and the client is a retired taxpayer, and it was a rental property that they've decided to sell, and the only income is pension income and the rental income, and so the accountant has already filed their 2022 tax return, including the capital gain on the disposal in March 22, and the capital gains tax normally would be payable on the 31st of January next year." And what the accountant said to me was that he was concerned that if he now tells the client that within a few weeks they've got to file an online return and pay an estimate of the tax, the client is going to blow his top, because why on earth should they have to do that given that they've already filed their tax return? And full credit to the revenue. Somebody at the revenue, when this online system was designed, had the good sense to recognize that there would be circumstances where a full self-assessment return was filed before the 60-day deadline, and it would be irksome beyond belief to make the taxpayer file again. And so the relevant legislation, and it's referred to, in fact, in one of the answers to this question, it's Finance Act 2019, Schedule 1, I think, paragraph 5, it may be Schedule 2. That legislation specifically provides that you don't have to file the online return, and nor do you have to pay the estimate of the CGT within that 60-day time limit. It used to be 30 days, but last October it was doubled to 60 days. You don't have to do it if you've already filed the self-assessment return for the relevant disposal. Now, this point, the answer to Gina's question is, it's absolutely right. You don't have to. It would be overkill. You don't have to do it. But this point is particularly pertinent at this time of year because it's only when you've got exchange of contracts towards the end of the tax year that you could actually file that tax year's tax return before the 2 months or 60 days deadline for the online system expires. So, we do it now, but we won't be able to do it in a few weeks' time, is the answer. And actually, the other question that came up this morning on that was, if I haven't got the actual figures he did for this client, can we file estimated figures in order to take advantage of this? To which the answer is yes. I'm going to stop you filing. I could file my tax return today with some estimated figures in it, and then correct the estimates later in the year.
And the question I was asked on this recently, did this rule change in October, this ability to do self-assessment instead? And the answer is no, it's always been that. It's just that with 30 days, we didn't really talk about it because, unless completion was very near the end of March, this simply wouldn't matter. You wouldn't be able to get everything done in time, but 60 buys us obviously a lot more time.
Well, you say 28th of March, but it does depend also on the period between exchange and completion, because you could exchange in March, which makes it the year about to end. It's a disposal for that year, but not complete for a couple of months. And of course, the 60 days doesn't start running until completion. So I might have exchanged a sale in March 22 for completion 1st of August. Well, that would mean that my filing deadline is not going to be until the end of September, my online filing deadline, end of September. And if I file my 22 tax return before that, then again, I'm forgiven having to do the online.
Potentially very interesting opportunity. And of course, not only the admin that we're saving there, but also the time to pay would make this incredibly attractive to some clients. Hopefully useful, hopefully covered topics that are of benefit to you. Please keep posting questions on any answers, and perhaps next time it'll be your question that we have a look at. But for today, bye-bye.